Hello, friends. In today's episode, we'll be looking at CVS Health Corporation, ticker symbol CVS. We'll be looking at the last 5 year performance of the stock, looking at some analyst projections, the upcoming earnings, and we'll review also the last earnings. We'll talk a little bit about the news. Then we jump into my Excel sheet and we'll look at the last 10 years of revenue, earnings, free cash flow, book value, debt levels, dividend history, outstanding shares, and then we'll try to come with a fair value. Welcome to Money Talks with Martin Reyes, where we learn to take care of our money and find great companies at great prices. If you like what you see, please subscribe and leave a like and a comment, whether it's in Facebook or in the podcast that you found those, and I will be delighted to answer some of your questions and kind of interact. Let me know what you think, what I'm missing in this analysis. Let's jump right in the last 5 years. In the last 5 days, the stock is up 1.4%. In the last month, is down 5.6%. In the last year, is down 13%. And in the last 5 years, it's up 13.4%. The 52-week low was at $64.41. Full disclosure, I own this company and I bought it at $66. Analysts think that it's going to be a strong buy with a possibility of going close to $94, which will be above 25% possibility of appreciation. When it comes to PE valuation, if you like just looking at those numbers, it's at 11 PE. And forward PE is at 8 times, almost 9 times earnings. For dividend investors, dividend they pay $2.66, which will be close to $3.59%. The ex-dividend already passed. And like I said, next in 2 weeks, they report again. For those that don't know about CVS, CVS is more than just a pharmacy. The pharmacy distribution and reimbursement system, it involves not just the pharmacy, but also the drug dealers, the drug dealers, the drug wholesalers, the manufacturers, and pharmacy benefit management. And of course, you have the health plans. So one of the cool things about CVS is that they're trying to take a position on a lot of these different places on the chain. They do have the pharmacies, but they also have CVS Health, which is a very convenient way to do to take care of your health through your phone and through the app, and it's mostly for those Aetna members. And yes, they own Aetna Healthcare, and they not only do private groups and private companies. I used to own Aetna. I know that they also do Medicare, Medicaid, so that's a good income for them. A CVS Mark is wherever they are able to fill the prescription, especially the specialty ones. They try to also they have the Signify Health. They bought it a couple of years ago, and it's an in-home evaluation that identifies complications for arthritis, and it's really good for older people. And then also they acquired not too long ago Oak Street Health, which is a group of local clinics. Because one of the things that CVS wants to do is want to provide. They have the insurance, they have the pharmacy, and they want to start providing clinics. So that is something that is very awesome, but at the same time, for a lot of investors, you kind of end up in two camps when it comes to CVS. You either think, oh my gosh, they're taking too much, and that's why they're taking too much and it's going to hit the bottom line? Are they going to be able to do this? Are they going to be another Walgreens? Or like me, you can also be like, wow, awesome. Whenever they get everything together, this is going to be an amazing company to own. And that's part of the reason why I own it. Lately is down. It experienced quite a drop. Partly is because they decided to close about 12 CVS stores that were in Target, in different targets, and a lot of people don't like that. But there is some of us that think just like this MarketBit article that it could actually help them to have a better financial numbers. So we're going to be jumping to my Excel sheet. If you would like to get the sheet, you can find it at Buy Me a Coffee. In the link is down in the description. Also, I'm going to be starting to publish some articles over there to give you more values. So if you want to go over there, leave me a review or leave me a message. I will highly appreciate that. So in the past 10 years, in revenue per share has been growing about 10%, which is really good. And in the last 5 years has slowed down a little bit at 7.6%. When it comes to earnings, they have been a little bit flat for my liking at 6%. But once again, a lot of this big numbers and jumps and stuff has to do with some acquisitions that they have done. So especially here in 2019, profit margins, as you can see, is average is 2.5%. And if they can go back to some of the profit margins in the past, that could really, really, really help them with, of course, with the earnings and growth. When it comes to free cash flow, in the past 10 years, they have grown at 10.7%. In the last 6 years at 6%. Free cash flow margins are at 4%, which is pretty nice. I really like this free cash flow growth, although they have been experiencing a little bit of a dip lately. When it comes to book value, it continues to grow at small amount at 6.3%, and in the last 5 years at less than 1%. Return on equity right now, average in the last 10 years, is at 10.6%, which is my minimal. Return on asset is 3%, and return on invested capital is close to 6%. Those numbers are low for me, but I'm looking more of an opportunity to get things under control, and I think the management can do that. When it comes to the dividend, they were flat for a couple of years as they were purchasing companies and different things. So, but it's still, if you have held it for the last 10 years, you have seen a 10% increase year over year. And in the last 5 years at 3.4. Payout ratio is a healthy 40%. When it comes to debt, it has grown a lot, and this is a little bit that is a little bit concerning. I like for this number to be at 5, so that they're able to pay their long-term debt within 5 years. But 6.3, it's okay. So in the last 10 years, it has grown 20%, and a lot of that has to do with acquisitions that they have done. When it comes to outstanding shares, we're going down really nice, and then they use debt and an equity to buy some of the acquisitions that we talked about, like Oak Street Clinics. So in the past 5 years, it has gone up 5%, and in the last 10 years, kind of remained flat. So with that, analysts are thinking that it will remain flat for the next 5 years at 2.3%. So I'm really looking for it to recuperate to normal numbers. We'll be looking at some right now at the fair value based on our evaluation. Just to remind you, I'm just a YouTuber. I'm not your financial advisor. This is for educational purposes. Do your due diligence. Do not buy a company just because I own it. Once again, I own this company. I may be completely wrong, and you assume the risk. So let's jump. Multiple valuation tells us that CVS fair price is somewhere between $78 to $90. When it comes to the payback time, we're looking at somewhere between $177 to $187. They produce a lot of free cash flow. That's just a crazy number. When it comes to earnings, the fair value will be somewhere between $48 to $45. And when it comes to earnings, owner's earnings valuation from Warren Buffett, we're looking to somewhere between $157 to $176. So when we put everything together, a fair value for this company comes down somewhere around $100 to $98, and which is kind of what the a little bit above what the analysts are predicting. So for me, because of some of the different issues that we talked about, like the debt and stuff like that, if I were to put a 30% margin of safety, you could be looking at buying it somewhere between $69 to $73, which will make it a little bit close to what it is right now. So I hope that that this gives you a little bit of an idea of the potential with CVS. Please leave me a comment. Tell me what you agree or disagree with it, and I hope to see you in the next video. Bye.